And welcome to ETF Edge, your go-to place for everything ETFs. I'm your host, Bob Pisani. Today we'll be talking about the IPO explosion, momentum and quality at new highs, and what to do about yields. That's a major problem. Our guests, three of the best in the business here: Kathleen Smith from Renaissance Capital, Christian Magoon from Amplify, and John Davi from Astoria Portfolio Advisors. Welcome, everybody, old friends, all of you. John, let me start with you. You've spoken often of your love for quality. You can actually buy this ETF, QUAL, right now. It's at a new high today. These are companies that have stable earnings growth generally, low debt to equity ratios overall. Why does the market like these type of stocks right now?
I believe that quality over time is one of these factors that's persistent, pervasive, robust. We've talked about this ETF quite a bit on your show, ETF Edge, and I think that it's names that everyone knows and can understand. But what we're doing lately, Bob, is we are shifting our portfolios. We are trimming quality. We still like it, but I think that where we are in the economic cycle, the Fed anchoring interest rates at 0%, the Fed doing quantitative easing, I think equities and stocks, broadly speaking, have a green light. So we are shifting our portfolio, owning more cyclically oriented stocks and sectors. Small caps, mid caps, they tend to grow a little bit faster than the overall market, and sectors like energy, industrials, materials. So that's a new twist from us at Astoria Advisors, and I think that that's what investors should be doing as well.
I think the key point here is, and Bruce, I don't know if you want to comment at all, but on this group here, Apple and Facebook shows up on quality. And again, you're looking at companies, low debt to equity ratio, generally good earnings growth, but you also have some very strong consumer names, not associated with big growth necessarily, but stable, Coca-Cola and Johnson & Johnson, for example. So it seems like the right kind of mix. You don't want to throw all your money into tech mega cap. It seems a little bit too much momentum oriented, but quality kind of strikes the right kind of tone for this market, doesn't it?
Yes, I do think so. But what I would point out, Bob, is that since March 24th, QUAL has underperformed the S&P 500 ETF by about 200 basis points. So, there is a change in market leadership, and that I think is important. But yes, I agree with you. You want to have, broad, diversified basket. You just don't want to own, large cap kind of tech stocks. So, that's the message from us, is to kind of tilt away, own more cyclically oriented portfolios. Yes, qual is reaching all-time highs, but so is the S&P 500. But since March 24th, the cyclically oriented sectors, small caps, they've really outperformed dramatically compared to the S&P 500. And that, as you look forward the next 12 to 18 months, I think that's what you want to be doing to your portfolio as we continue to rebound from an economic perspective.
Yeah. Sorry, Christian, I meant to toss to you there. I don't know if you have any thoughts on this. I know you watch the market as well. And I can't help but think, just to repeat the question, I can't help but think that quality is a good way to look at the market right now, even over momentum, because here you're getting stocks that have generally improving earnings, but also low debt to equity ratios, what people would consider some kind of modest value tilt as well.
That's right, Bob. I think, after the COVID crisis, people really want resilience in the companies they own, and Qual really provides that when, it looks at companies that have stable earnings, high return on equity, low debt to equity, all characteristics to kind of batten down the hatches, if you will, against the kind of this unusual economy, and this resilience in these companies in the form of these characteristics, we think not only make a good, investment here in the times of COVID, but should last for quite a long time. And, the performance of Qual has been pretty nice, since not only year to date, but, going back several years. So an interesting ETF. 32% in IT, Facebook, and Google, though, so it might be getting a little ahead of itself in terms of some of its technology and communication exposure.